Are you paying yourself the right way from your UAE business? Many owners are now losing thousands in unnecessary tax simply because they don't understand how shareholder salary and company expenses are treated under UAE corporate tax law. And don't let that be you. In this video, I'll break down how to structure your payments smartly, which will maximize deduction and keep more profit in your pockets. And that all within UAE corporate tax law. So before we dive into shareholder salary versus company expenses, let's quickly set the stage with new UAE corporate tax landscape. As of 1st June 2023, the UAE officially introduced a federal corporate tax, something that was unheard of for decades. Business now are paying 0% tax on its first 375,000 taxable income, but anything above of that are taxed at the rate of 9%. That means to say, if your company earns 1 million dirham, in that case, 375 will be taxed at the rate of 0%. It means no tax. And above of that, that is the remaining one, 625 are, this amount will be taxed at the rate of 9%, which comes to 56,250 dirham. And here is where it gets interesting. So how you pay yourself as a shareholder or how you structure company expenses will directly impact your taxable income figure. So if you don't plan strategically, you may end up paying much higher tax bill than necessary. So in this video, I will cover how shareholder salary are treated in UAE corporate tax law, when salary, whether salary or company expenses, which will works better, and the core principle of ensuring tax deductibility in UAE. Therefore, stick with me until the end because I will also share some real world example of UAE business making mistakes and how you can avoid them. So let's start with shareholder salary. So in UAE corporate tax regime, salary paid to the shareholders who are actively working in the business can be treated as deductible expenses. That means it will reduce your taxable company's taxable profit. The advantage will be the shareholders will be provided with a stream income, personal income, steady personal income, and shareholders can also structure in a way that looks reasonable in the market. That means similar to what another company would pay someone for the same roles and responsibilities. That means it should be at arm's length price. And it will reduce your company's taxable base. For example, if your company makes 1 million dirham profit and you pay yourself 300,000 as a reasonable salary, then only 700,000 is left for corporate tax calculation. Therefore, your taxable income tax amount will be lower by 300, or once you do calculation, you will see the impact. But here is the catch, and the salary must be reasonable and justifiable. So if you pay yourself 1 million salary while similar role in the UAE market pay only 300,000, in that case federal tax authority may challenge and reclassify it, and any excessive salary will be treated as a form of profit distribution which are not deductible. Therefore, always keep your profit, shareholders profit, reasonable and justifiable. But documentation is more critical. So if you don't have documents to prove this, it will still be not deductible. Therefore, you need a contract, payroll records, or proof of actual work performed. So paying shareholder salary is powerful tool, but only when done with reasonable compensation rules and supported with documentation, then only uh, it will be a powerful tool to reduce your tax base and pay lower tax to the government. Now let's compare salaries, shareholders' salaries with company expenses. So some shareholders prefer not to take salary and instead let the company pay for business related expenses like office rent, staff training, marketing, travel for client meeting or IT systems. So when salary makes sense, let's see. So if you are an active shareholder working full time in the business, your effort deserve compensation, right? And then the company benefits, also the company benefits from tax deduction. So if you want predictable income as a shareholder, so I'm as a shareholder want predictable income like some sorts of income from me while also keeping my company's profit lower, which will reduce the tax base, then this is best suit for any business owner or any companies. So when, but if shareholders are not actively involved, suppose I'm not actively involved in my company's day-to-day operation, still I'm paying salary. Here it could be a risky, because when the company can legitimately claim other expenses such as hiring professional or outsourcing services or investing in growth activities. But here I am getting salary, but there is no any contribution of me in the company's operations, in running the company. So this will not be regarded as legitimate expenses for companies from corporate tax perspective. So it will still be risky, and it will may FTM may impose fines and penalty for wrongly reporting it, wrongly presenting it, or wrongly taking deductions of expenses. And here is a practical UAE example. A company, a consultancy firm, has two founders. One works daily as a managing director, while other lives abroad and is not involved in any operations of the company. Now, UAE tax authority would allow a salary deduction for the active director who are uh, involving in day-to-day operation of the company, but not for the passive one who are just withdrawing salary to reduce the tax basis. For the second shareholders here, profit are this salary will be treated as profit distributed as a dividend and which are not deductible in UAE corporate tax law. That's why you need a you need to be a careful balances. So salary for active shareholders, okay, done. Company expenses for legitimate expenses, done. But salary just to show, just to reduce your tax base is not allowed. Therefore, the combination like salary for active shareholders and the company expenses, legitimate expenses, this combination ensures you maximize tax while staying fully compliant with UAE corporate tax law. Now, now let's bring it all together with core principle of tax deductibility rule under UAE corporate tax law. So, to be a deductible, and expenses must be wholly and exclusively incurred for business purposes. That means there should not be any personal dining, personal dinners, or luxury car for family use or vacations as a business trip. It means it should be whatever expenses, that expenses must be 100% is committed or incurred for the business development, business purposes to run the businesses. And another thing is that it must be reasonable and market aligned. That means it must flow arm's length price principle. So for those who have no knowledge of who does not know the concept of arm's length price principle, it means the market price. Simply it means the market price. Suppose I am working in my company as a chartered accountant for 5 years of experience and with certain roles and responsibility. So if I go with this CV in the market, how much would I get? suppose 20,000, then I can take it 25,000, 18,000, but the variance should not be much. In the market, my value is 20,000, and uh, in my company, from my company, I'm withdrawing 50,000. This is not reasonable, and this will not be market aligned, and it does not fulfill the principle of arm's length price. Therefore, here it will be the risky. And most important, it must be well documented. So you must maintain invoices, contract, pay slip, bank transfer, and accounting entries. So without proof, UFTA can deny the deductions and also impose the penalty. And fourth is compliant with UAE law. So for example, certain fines, penalties, and bribes, these are regarded as these are not regarded as business expenses. These are regarded, therefore, are not deductible under UAE corporate tax law. So, as a quick case study, a Dubai-based trading company tried to deduct shareholders' personal house rent, like as a company expenses. But when FTA audited, found it is not a business expenses. So this allowed, along with this allowance, FTA impose penalties too. So what lesson we learn from here? You should be smart, but stay within the rule. Play smart, but within the rule. So you don't want deduction. You don't want deductions. You want deductions that survive the audit. Means we don't want deduction which are not which cannot survive under audit, FTA audit, or tax scrutiny by FTA. We want deduction that can survive in any situation. That means if it is legitimate, it will survive. Otherwise, it will be risky. Therefore, regular review, internal controls, and consultation with your tax advisors are essential. Remember, UA corporate tax environment is new now. The FTA may not be watching closely all these things, but after 2 to 3 years, it will surely watch. And whatever mistakes or um, non-compliant we have committed now may be highlighted in future too. Therefore, start playing with rules from now only. So after all this, what we have learned today? Number one, UAE new corporate tax regime makes making strategic planning is most essential. Shareholder salary can reduce your tax base, but only if they are reasonable and backed with documentation. Company expenses should be legitimate, business related, and compliant. And the right mix of salary and expenses can significantly reduce your corporate tax liability. My advice, don't treat this as one-time setup. Review your financial structure regularly, especially as your business grows. So what works in 2023 may not be beneficial, may not work in 2025, 2026, or in the future. Therefore, the early you adopt, the more tax you can save. If you want to stop overpaying taxes and start planning smarter under UA corporate tax law, please hit the like button, subscribe, and turn on notification, because the right tax strategy could save you thousands every single years. And if you still have questions, drop them in the comment section. I would love to help you plan smarter and maximize your profit. Thank you so much.